Well, joining us now for some market strategy is Piers Curran, head of trading at Amplify Trading, and still along for the ride, Roger Nightingale, strategist at Point in York. Piers, let me ask you, in the States, we don't have much on the earnings calendar. The economic calendar is pretty quiet. We have no Fed meeting. The World Series is behind us. What's kind of pushed this market higher or lower this week? It's always the unforeseen, they say, like maybe 80 billion in treasury auctions or maybe a hurricane in the Gulf of Mexico. Yeah,
I mean, you're right. It's unusual this week. We've been having, economic calendars that have been packed with the quarter three earnings, of course. Really, it feels like the last sort of 6 weeks. So it's actually nice to have a bit more of a relaxed week. And I think the markets, given what happened on Friday and given what happened over the weekend, with G20, I think the markets are going to be on the front foot this week. I think we'll trend higher. On fairly low volumes, I would say, and there's no reason why we can't be up towards the highs of 2009 towards the end of this week, start of next week.
So, what's your major area of concern out there? I mean, I get nervous when there's too much, easy money, and this looks like a free week kind of sentiment out there, and I'm hearing a lot of it.
Yes, absolutely. I mean, I don't think there's anything in the way this week, to be honest. It's all the important events are at the end of the week. We've got Walmart reporting and we've got the University of Michigan consumer sentiment. Before then, there's literally nothing. We've got jobless, of course, on Thursday, but I think it's going to be a pretty straightforward week in terms of trading. I don't think there's going to be too much to shock these markets or to worry these markets.
Except we've got a ton of treasury issuance coming down the pipe, and if that doesn't get sold as well as we hope, is that the one thing that might knock stock traders out of their strides?
We've had so much already that's gone, fine. I don't think that's an issue. I don't think people are looking at that too much.
Would you buy it, Roger?
Well, yes, I would, because in fact I think inflation is going to be so low and interest rates will be so low for so long. But I think actually it was the Treasury issuance that caused a little bit of a hiccup a couple of weeks or so ago. My calculation, my suspicion is that the Fed didn't quite balance the numbers properly, and they had an accidental tightening of money then, which caused markets to fall away a little bit, caused the dollar to strengthen a little bit. They saw what was happening and reversed it very quickly indeed, put the money back into the system, and the markets rebounded. And I think it was accidental. They didn't mean to tighten. They want to keep the issuance going in the context of loose money.
Yeah. I think that's right. I mean, it's all about stimulus, and the markets got worried a couple of weeks ago because they thought, okay, maybe stimulus is going to be removed here, and the markets aren't ready for that, and they've adjusted it, and the confidence for risk is back there, and you've seen that with the markets opening higher this morning, and I think that confidence with the G20 just confirming that over the weekend, I think that was important. That's exactly what the markets wanted, unified agreement that stimulus will remain in place until we get better evidence, that recovery will be moving forwards.
Yes, this is Christine. I mean, on a week like this, on a quiet week like this, a lot of focus on what happens in China. Of course, we have economic data expected to come out of China later this week. If we do get a strong piece of number, we do get a strong piece of data coming up from China, could that be an impetus for markets to rise further from here?
I'm surprised, actually. I don't know. I think, in fact, actually the markets do better when the economics numbers are moderately weak. I think strong numbers from China, and I don't think they've yet been strong, but in fact if you were to get strong numbers, I think what you would get is the possibility of interest rates being raised, of money being tightened. I think that would be the negative, but I think I'm pretty sure it's not going to happen.
Yes, what about you? You agree?
I'm a little bit less worried about really good economic data now, given what happened over the weekend with the G20. So I think if we do get stellar economic data from China, it won't have that negative impact that it would have had a couple of weeks ago. So I'm not too concerned about that. I think good news from China is going to be good news for the stock markets.
Piers, I might as well be in a little fuzzy suit and dress up like a bear, because when I see 83% of the S&P 500 stocks beating estimates, that to me says the analysts had an awful quarter, right? They were wrong 83% of the time by an almost record margin. And what does that bode for the fourth quarter, where we're expected to see a 200% snapback, albeit from unbelievably low levels in the S&P 500?
Well, I mean, analysts, they were upgrading forecasts continually going into the Q3 earnings season. Yes, still 83% of companies beat, bottom line forecasts. I think it's a combination of, okay, conservative forecasting, and also I think you've got to factor in that the companies have actually done phenomenally well this year in terms of cost cutting to survive a pretty severe recession. And now, you saw the productivity numbers last week. They're now clearly very well leveraged going into an economic recovery, and I think that's good news. I mean, you can, like with any of these stories, you can spin it positively or negatively. I think I'm on the positive side of the camp.
All right, this is going to be fun. Piers Kerr,